In the previous video, we have talked about what is the difference between the factor income and the transfer income. Basically, the factor income belongs to LLCE, means to say land, labor, capital, and entrepreneur, where the land is basically based for rent, labor is basically work for wages, and the capital for interest, as well as entrepreneur start the business for the profit. What is the transfer income? So the transfer income basically based on the donation, charity, help or remittance, in which where the factors are not involved, it calls transfer income. After the transfer income and the factor income, we know about the concept of domestic income and the national income. In the domestic income is basically based on economic territory. Basically work for the economic territory means the nation where the persons working for the economic interest, even they are from the India, even they are working from the foreign countries. If they are working in particular domestic territory in the accounting year, whatever the services or the income they has generate, it comes in the domestic income. About the national income, it's basically based on the person who is lives or originated from wherever. If they are working in the domestic or they are working in the foreign countries, it's all together included in the national income. What I mean to say here, in the economic territory, whoever work, it comes in domestic income, and the originated person work wherever, it comes in national income. So, how we check the net factor income from abroad? So basically, it's based on the net factor income to abroad minus factor income from abroad, or the factor income from abroad minus factor income to abroad. Whatever the foreigners earn from our country, we need to return it, and whatever our Indians work in the rest of the world, that's we will get it back. So that's the difference. It's called net factor income from abroad, NFIA. Net factor income from abroad refers the difference between factor income received from the rest of the world and factor income paid to the rest of the world. NFIA, net factor income from abroad, is equal to factor income earned by our resident from rest of the world minus factor income earned by non-resident in our domestic territory. There's a one question is about NFIA is equal to 10,000, and also FIA is called FITA. Factor income to abroad is equal to 7,000. So how do we find factor income from abroad? So factor income from abroad minus factor income to abroad is equal to net factor income from abroad. So together it's 10,000 minus 7,000 is equal to 3,000. So that's the value is factor income from abroad. It's the same rule you need to apply in the second and the third question. So domestic income and national income, how they are related. So domestic income plus net factor income from abroad, together it's work for national income. National income or national product. Basically they are all three identical. The product and the income identically the same. So domestic income plus net factor income from abroad is equal to national income, or national product is equal to domestic product plus net factor income from abroad. How they relate? You can see here like national product, domestic product is plus and minus relation to represent the formula. If French company located in India, it comes in domestic territory because it's work here. A branch of Microsoft office in India, so it's located in India, so definitely it's in India, so it's domestic territory. Indian embassy work in China. So embassy is an international assets. So wherever it is located comes in the domestic territory of that country. So it's in domestic territory of India. Office of Reliance Industries is a private organization. Wherever it's located, it doesn't matter. It is not in domestic territory. A company in India owned by a Chinese, so company owner is not an officer, is not a government agency or international like the organization. So it's definitely domestic territory. Gross and net domestic product basically belongs to like G is equal to N plus T, gross is equal to net plus depreciation. Is they relate like this formula or is this figure like plus minus relation, gross is equal to net plus depreciation, or gross minus depreciation is equal to net domestic product. Depreciation used in several ways like compensation of fixed capital, current replacement cost of fixed capital, com- capital compensation, capital consumption allowance, or loss of value in capital of fixed assets used. You will have to calculate like the capital value of assets if it's given there is 20,000. Estimate value of assets is 20 year. Scrap value is nil. So how do we find the depreciation? So it's directly like capital value of assets upon estimated life of assets is 20,000 by 20 is equal to 1,000. In the depreciation of capital assets, so the second question is estimated life of assets is 20 year. Capital value of assets is equal to 35 crore or the scrap value is 500. So you need to just 3500 remove the scrap value or 3500 minus 500 is equal to 3000 by 20. 3000 by 20, so it comes to 150. So that's the scrap value. That's the depreciation on capital assets. Thank you. And if you are new, please subscribe.